Today, twists and turns in the bond market. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. Well, now Boris Johnston has said he's not going to stand for British PM. The path may be open to Rishi Sunak to bring some sense to British politics. But this does not necessarily solve the broader financial pressures that we're seeing, for example, in the bond market, in the UK or indeed elsewhere. Indeed, the Bank of England has said that they'll start selling short-term government gilts as part of its QT programme, having recently bought bonds further out down the yield curve. Now, this reminded me of the famous Operation Twist, a name given to a type of monetary policy operation performed by central banks, which involved buying and selling government bonds at the same time in an effort to provide monetary easing for the economy, although it's not quite so aggressive as quantitative easing. In fact, the term Operation Twist was first used in 1961 in reference to a Chubby Checker song and the dance craze it engendered when the Fed employed a similar policy. The newer Operation Twist was instituted in two parts. The first part ran in the US from September 2011 through to June of 2012 and involved the redeployment of around $400 billion in Fed assets. The second ran from July 2012 through to December 2012 and included a total of $267 billion. But the Fed announced the second phase of this newer Operation Twist in response to continued sluggish growth in the US economy, and in December 2012 the Fed said it would end the program and replace it with a stronger version of its existing policy of quantitative easing, which of course seeks to lower long-term rates by making open market purchases of longer-dated US Treasuries and also mortgage-backed securities. Now, of course, central banks are trying to move to QT rather than QE, as well as moving interest rates higher, all to tame inflation. But the question is, could we see this twist type of operation again as the battle to fight inflation, now stubbornly entrenched, is driving rates higher, risking higher unemployment and even a recession? Could we see a whole new front open up in economic policy using twist type operations again? The idea is that by purchasing longer-term bonds, you can help drive prices up and yields down, since prices and yields move in opposite directions. At the same time, selling shorter-term bonds should cause their yields to go up, since their price would fall. And in combination, those two actions twist the shape of the yield curve. Lower longer-term yields can boost the economy by making loans less expensive for those looking to buy homes, purchase cars and finance projects, while saving becomes less desirable because it doesn't pay as much interest. Now, it's conceivable this could create capacity for governments to spend more again. But wait, there is more. If you then added in a central bank digital currency, central planners could then direct spending and interest rates more specifically at certain sectors of the economy. For example, they may offer cheap money for small business investment, but expensive money for vehicle purchases as a potential mechanism to bring supply and demand back into balance and so help address the inflation problem. This might mean interest rates would not need to go up so high. And it also expands the role of the central bank to the point where it almost merges back into the government treasury operations. Now, in a recent show, I discussed the potential for central bank digital currencies to be foisted on us and made the point that the IMF and the BIS, among others, saw this as a mechanism to provide, quote, extra monetary policy tools. For that, read more control of the economy. So, why could this be relevant now? Well, we know the massive bond markets are under extreme pressures. Analysts at Bank of America are worried about the state of the US Treasury market. In our view, declining liquidity and resiliency of the Treasury market arguably poses one of the greatest threats to global financial stability today, potentially worse than the housing bubble of 2004 to 2007, they wrote. And they noted that if the Treasury market really hits the wall, the effects could cause even greater disruptions to the US economy than those seen in the financial crisis over a decade ago. For example, after the near-death experience of the trillion-pound pension sector, the Financial Times reported on Sunday that Britain's financial watchdog has been consulting private equity firms about the effects on the companies and their investors of rising rates and the bond market tumult triggered by the government's failed mini-budget. Officials at the Financial Conduct Authority contacted several buyout groups to try to find out how badly the turmoil had hit pension funds and other investors, while also quizzing them about the effects on private markets, according to the report. And there are signs that Japan's Ministry of Finance sold securities last week, intervening for the second time in the month. And Wall Street is wondering whether this may fuel more volatility in the Treasury market and exactly how Japan is funding those dollar sales. The value of US Treasuries owned by Japanese investors slid by about 3% in August, to the lowest level in 3 years, as a slump in global debt markets hammered down prices. The dollar value of US sovereign securities held by official and private investors from the Asian nation fell by $34.5 billion to $1.2 trillion, according to figures from the US Treasury. The decline came even as Japanese investors had been net purchasers of US Treasury bonds in August for a second month. Until 2 weeks ago, foreign central banks had been shedding holdings of US Treasuries, which suggested institutions were selling bonds to stockpile cash. There's also the possibility the Bank of Japan drained ready funds parked at the Federal Reserve's Foreign Reserve Repurchase Agreement facility. The worry is that even if the BOJ has cash for intervention now, the rate at which they're intervening will require them to sell more treasuries for future interventions, said TD Securities strategy Glendilly Goldberg. That's really what's driving the fear. Treasuries cheapened in early trading on Friday, with yields soaring across the long end, and spreads steepened as traders braced for potential Japanese intervention as the yen extended past 150. The Ministry of Finance disclosed last month that it spent 2.84 trillion yen, or $19.7 billion in September, to slow the yen's slide in its first intervention to support the currency since 1998. Some analysts have estimated the intervention is somewhere around 3.6 trillion yen now. And Wall Street strategists initially assumed Japan removed cash from the Fed. After all, the island nation has historically been the largest user of the foreign reverse repo pool, with an estimated more than $110 billion of cash parked there. Instead, the Ministry of Finance foreign reserves for September showed securities were worth $984 billion from $1.037 trillion the prior month, while deposits were little changed, an indication Japan sold holdings to finance its intervention. More recently, though, foreign central banks replenished their treasury holdings at the New York Fed for the second straight week, with the total rising $6 billion through the week ended October the 19th, after rising by $11 billion the prior week. And by comparison, official holdings of treasuries fell by $82 billion in the 6 weeks ending October the 5th. Cash parked at the Fed's foreign RRP pool is near an all-time high, and meanwhile foreign central banks slashed $330 billion at the Fed's reverse repurchase agreement facility, according to the data for the period through to October the 19th. That's down from a record $333 billion a week earlier. That's still, though, $55 billion above the year-to-date average. And the world's largest bond market is being whipsawed by its longest stretch of sustained volatility since the onset of the financial crisis in 2007, marking a stark break with the stability seen during the long era of historically low interest rates. And the uncertainty that's driving it doesn't appear set to fade anytime soon. Inflation is still running at a 4-decade high. The Federal Reserve is raising interest rates aggressively, and Wall Street is struggling to gauge how well a still resilient economy will hold up. The upshot is that money managers see no respite from the turbulence. Bond market volatility will stay elevated for the next 6 to 12 months, said a portfolio manager and head of multi-asset strategy at Columbia Threadneedle. The Fed could pause its rate hikes next year only to resume if the economy is stronger than expected. The sustained volatility has driven some major buyers to the sidelines, draining cash from a market contending with the worst annual loss since at least the early 1970s. And on Thursday, Bank of America analysts warned that Treasury market liquidity, or the ease with which bonds are traded, has deteriorated to the worst since the COVID crash of March 2020, leaving it fragile and vulnerable to shock. And after retreating from June through early August, Treasury yields have surged back as a key measure of inflation jumped in September to the highest since 1982, and employment has remained strong. Those figures and comments from federal officials have led the market to expect that the Fed will push its rate to peak nearly 5% earlier next year, up from a range of 3 to 3.25% now. And the uncertainty was underscored on Friday when two-year Treasury yields rose only to tumble by as much as 16 basis points after the Wall Street Journal reported that the Fed is likely to discuss plans to potentially slow the pace of its rate hikes after next month. If they pause after inflation is falling and the economy is slowing, then market volatility will decline, said Steve Bartoloni, portfolio manager at fixed income for T. Rowe Price. The day the Fed pauses should see volatility climb, but we're unlikely to go back to the low volatility regime of the 2010s. While high volatility can provide buying opportunities, any effort to call a bottom has been thwarted as yields drifted higher. Moreover, investors are also mindful that recessions and financial crises that have followed excessive monetary tightening in the past were associated with notable spikes in volatility. That potentially spells more pain for leveraged financial investments that took off in a world of low inflation rates and volatility, said BlackRock's Bob Miller, head of America's fundamental fixed income. But for other investors, there will be opportunities to take advantage of dislocations in the market and build fixed income portfolios with attractive yields above 5%. Still, he expects the market to continue to be buffeted by price swings. Implied volatility is clearly the most elevated since 1987, outside of the global financial crisis, Miller said. We're not going back to the prior decade experience anytime soon. So in closing, the Group of 30, or the G30, that's a private non-profit international body composed of academic economists, company chiefs and representatives of national, regional and central banks, said in a July 2021 report that the Treasury market is the biggest, most single important financial market in the world, as Treasury rates are a fundamental benchmark for pricing virtually all other financial assets. This means that confidence in the US Treasury market is essential for the stability of the global financial system. So all up, I would not be at all surprised to see some of these old twist techniques becoming new again, as central planners around the world try to put years of poor policy and high debt back in the bottle by trying to control yet more elements of the economy, which is a ways away from free market capitalism, but of course a central planner's dream. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.